Today I'm going to be talking about a late Roman gold Solidus.
Every empire swears its money is safe, and every government insists its promises will last forever, and every single time, history proves them wrong. From Rome to France and from the Confederacy to modern Lebanon, people have woken up to find their savings worthless, and their salaries meaningless, and their futures stolen by systems they thought were solid. Currency collapse isn't rare because currency collapse is the rule. Financial collapse happens over and over again, and the real question isn't whether money fails, but how you protect yourself when it does. Take the Byzantine Empire, often remembered as the eastern half of Rome, that somehow survived 1,000 years after the Western Empire fell. At the heart of its economy sat the gold Solidus, a coin so reliable that merchants across Europe and the Middle East and Asia accepted it without question. And for centuries, it was the closest thing the medieval world had to a global reserve currency. But here's the part you need understanding. You'd think they would have learned from Rome's earlier disaster with the silver denarius when emperors kept debasing it until it became basically tin with a silver wash. But no. Centuries later, the Byzantines made the exact same mistake in gold. Shaving its purity began, stretching it thinner, and mixing in cheaper metals. At first, nobody noticed, but then trust cracked, and the coin that had anchored Mediterranean trade for centuries became just another piece of political fiction. The debasement destroyed its credibility, and with it, the Byzantine economy lost the stability it had once enjoyed. What survived? Not paper promises and not government decrees, but merchants who had quietly hoarded real gold or land outside imperial reach preserved their wealth while everyone else saw their money evaporate. That's the first timeless lesson. Governments cannot resist the temptation to dilute their money, and when they do, real value flees to assets they cannot counterfeit. Not every collapse comes from rulers tinkering with coins, though, because sometimes it comes from shocks that strike out of nowhere. The mid-13th century brought Europe the most devastating pandemic in its history, when the Black Death killed as many as half of all Europeans between 1347 and 1351, emptying cities and vanishing villages and breaking down trade routes. Yet the economic story of the plague runs more complex than simple catastrophe, because when half the labor force disappears, labor becomes precious. Survivors could demand higher wages, while food and land, once scarce, became relatively abundant compared to people. Families with liquidity, with silver or goods, or even just the ability to work, suddenly had leverage they never dreamed of. Land that once cost a fortune could be bought for a fraction, as houses stood abandoned and fields went unplowed, and survivors found themselves in a buyer's market. If this sounds uncomfortably familiar, it should. COVID pandemic brought us a modern version of this, where supply chains disrupted and governments printed trillions to keep the machine from seizing up, and a wave of inequality emerged as those with liquidity bought assets while those living paycheck to paycheck stepped further behind. United States housing prices soared and stock markets recovered almost instantly, while millions of ordinary people scrambled to cover rent. The rhyme is clear because pandemics redistribute wealth, and they always have. Black Death survivors leveraged scarcity to climb the social ladder, while COVID survivors with liquidity scooped up property and stocks and businesses that others could no longer hold. The lesson is not comforting, but it is true. Crises reward those with reserves and punish those without them. Before we continue, though, something needs saying. These collapse patterns, understanding how entire economies can implode, not from war, but from loss of trust, this diverges sharply from what financial advisors tell you. Real wealth protection requires understanding these historical cycles, so hit that subscribe button because it helps the channel, and these money disasters need exposing before they repeat. Drop a comment too, because I genuinely want knowing which collapse scenario worries you most. While pandemics show us how fast shocks can flip an economy, the collapse of banking in Renaissance Florence shows us something just as vital: that institutions looking too big to fail can fall like dominoes. The 1340s made Florence Europe's financial capital, home to powerful banking families like the Bardi and Peruzzi, who had lent heavily to kings, most disastrously to Edward III of England, who defaulted on enormous loans during his wars with France. When Edward stopped paying, the banks collapsed, and depositors were ruined and trade froze, throwing Florence, once rich and powerful, into turmoil. Ordinary citizens who had trusted the city's mighty banking dynasties discovered that size was not safety and reputation was not protection. What did people learn? That too big to fail is a lie as old as finance itself. And institutions exist to profit, not to guarantee your survival. When they fall, they will take your savings with them. The lesson repeats in every century, from the Florentine crash to Lehman Brothers in 2008 to the banks of Lebanon freezing accounts in 2019. And survival belongs to those who recognize that an institution's promises are only good until the day they aren't. The American Civil War is remembered for its battles and its politics and the abolition of slavery, but behind the gunpowder and speeches ran a brutal financial war that most Americans today barely understand. The Union and the Confederacy both discovered that war on that scale required printing money. The North issued greenbacks as paper currency not backed by gold, but by the promise of the United States itself. At first, the experiment seemed bold and patriotic, but the more greenbacks that flooded the economy, the less they bought as inflation eroded the value and trust wavered. In the South, the problem was even worse. Desperation for resources drove the Confederacy to print graybacks in staggering quantities, and by war's end, Confederate inflation had reached almost unimaginable levels, with prices rising thousands of %. Soldiers' paychecks were worthless before they could even spend them, while families carried bags of bills that could barely buy a loaf of bread. By 1865, Confederate currency was not just weak, but dead. What mattered in that collapse was not paper promises, but hard assets. Land and food and gold. Anything real held value, while money became a cruel joke. For ordinary Southerners, this was devastating as lifelong savings vanished into dust. But for opportunists with access to tangible goods, the war was a chance to seize property and wealth at fire sale prices. It is a lesson Americans rarely hear but should never forget. Your own country has already lived through currency collapse. And when it happened, protection came not from trusting the paper in your wallet, but from holding value the system could not inflate away. France offers a brutal case study in how revolutions can destroy money faster than any war. The 1790s brought revolutionaries toppling the monarchy and seizing church lands, and they issued a new paper currency called the assignats, backed in theory by the value of confiscated property. These notes were supposed to stabilize the economy, but instead the government printed them with abandon. Each new issue diluted the last, while prices spiraled upward and wages failed to keep pace, and soon the assignat became worthless. Farmers refused to sell food for paper and demanded goods or silver instead. In Paris, the bread riots returned, and the revolution devoured itself. The winners in this collapse weren't the ones holding patriotic paper, but the ones who held food or gold or property, things the government couldn't print. For the ordinary Parisian, the lesson came to light that promises, no matter how noble, are only worth what others will accept. And when trust breaks, your savings don't just shrink, but vanish. Fast forward 2 centuries, and the lesson reappears in Asia. 1997 began as a speculative attack on the Thai baht, but spiraled into a regional crisis. And Thailand had borrowed heavily in dollars, confident that its currency peg would hold. But when it collapsed, debts in foreign currency became unpayable overnight. Investors fled while currencies across Southeast Asia, Indonesia, and Malaysia and South Korea collapsed in a chain reaction. Economies shrank and unemployment soared, and governments begged the IMF for rescue. The people who suffered most were not the global hedge funds who sparked the panic, but ordinary citizens whose savings lost value and whose mortgages doubled in cost and whose jobs evaporated. Yet the pattern was painfully familiar because those who held dollars or assets abroad survived better than those who trusted local currency. Nations dependent on foreign debt were forced into austerity, while Wall Street institutions walked away with fire sale deals on Asian assets. What looked like a local collapse was, in truth, a global transfer of wealth. The lesson echoes every collapse from Byzantium to Argentina. Debt in someone else's money is a death trap. And when the storm hits, it isn't the creditor who drowns, but the debtor. By now, the picture should be clear. Whether it's revolutionary France or Civil War America or modern Asia, the same themes repeat where paper money collapses and debt chains nations and families. And those who survive are never the ones who trust most in the system, but the ones who recognize its fragility before it cracks. The most chilling part of history is that collapse isn't just ancient or distant because it's happening now. Lebanon between 2019 and 2021 saw banks do something that still feels unthinkable to most people in the developed world. They locked the doors, and citizens woke up to find their deposits frozen and withdrawals limited and their currency collapsing. The Lebanese pound lost over 90% of its value as a lifetime of savings became pocket change. People lined up outside banks begging for access to their own money, only to be told it was gone. And it wasn't just small savers. Middle-class families and retirees and doctors and engineers, anyone who had trusted the system was wiped out. The lesson was brutal and clear. Your money in the bank is not a treasure chest, but a loan you've made to an institution that can decide in a crisis not to pay you back. Survivors who did best were those who had either diversified abroad or held real assets like gold or property or kept cash outside the banking system. Everyone else was trapped. If this sounds far away, it shouldn't. 2008 brought Americans watching their homes repossessed and their pensions decimated, while banks that caused the crisis were bailed out. And 2020 during the pandemic saw trillions printed to keep the machine alive. A lifeline that inflated asset prices for the wealthy while leaving ordinary wages stagnant. 2023 brought regional banks in the United States collapsing almost overnight when depositors lost confidence, reminding everyone that the safety of too big to fail is a fairy tale we tell ourselves until the day the doors slam shut. So how do you protect yourself when everything falls apart? History shows there is no single answer. In Byzantium, it was gold. After the Black Death, it was liquidity to buy abandoned land. In Florence, it was not trusting too big to fail bankers. In the Confederacy, it was hard goods. In France, it was food and property. In Asia, it was avoiding debt in someone else's currency. In Lebanon, it was getting out of the banks before they closed their doors. The patterns change, but the theme is constant. Survival comes not from blind trust in paper or institutions, but from recognizing what holds real value when illusions collapse. And here is a paradox that should wake you up. Collapse is both a tragedy and an opportunity, because for the unprepared, it is ruin. But for those with resilience or liquidity or assets that cannot be printed away, it is the moment to acquire wealth at a fraction of its former cost. After the Black Death, peasants became landowners because there was too much land and not enough people to farm it. After 2008, those with cash bought homes while millions faced foreclosure. And history shows us that protection is not just about defense, but also about positioning yourself to seize what others under pressure are forced to give up. But wealth isn't only about what you own, because it's also about what you can do. Survivors of history weren't just those who had gold or property, but those who could create value when others could not. The baker who could still provide bread, and the craftsman who could repair tools, and the farmer who could feed a community, and the merchant who could move goods across borders. These were the people who didn't just survive collapses, but rose in them. In every crisis, money loses meaning, but production never does. People still need to eat, and to build, and to trade, and to live. And those who can meet those needs are never poor for long. That's the deeper protection, not blind faith in institutions, and not the hope that governments or banks will save you, but the combination of real assets and real skills and the awareness that illusions always collapse. Every crisis is a transfer from the many who trusted to the few who prepared, from paper promises to tangible value, and from passive savers to active builders. And history has shown this pattern again and again. So the question is not whether everything falls apart, because it always does. The question is whether you will be one of the many left holding promises or one of the few holding something real. Thanks for watching. Here's what I want knowing from you though. If you had to choose just one protection strategy from all these historical collapses, would you prioritize holding physical assets like gold and land? Or would you focus on developing skills that create value regardless of what currency does? That choice determines whether you survive the next collapse passively or actively. So drop your take in the comments, because I genuinely want hearing how you're positioning yourself. History doesn't repeat, but if you ignore it, it will crush you all the same.